And if you go back December 2020 through November 21, that was an absolutely massive move for the miners relative to the metal. We think we're on the cusp of another move like that. So that, which is to say, we could call that the second big leg of the market. That's what we believe is coming. 5 years later, this is really a stretched out bull market. This is going to be a generational trade. This is going to continue for many, many years into the future.
Capital my name is Danny. It is July 2nd, 2025, and my guest today is the uranium insider himself, Justin Huhn, to give us an update on the uranium market. Justin, thank you so much for coming back on the show, my friend.
It's always my pleasure. Good to see you, Danny.
Yeah, likewise. Let us just dive right in, Justin. For those of us keeping score at home, we're looking at some pretty interesting moves in the uranium ETS. Most notably, URA hitting a decade-long high. URNM hasn't quite hit that same decade-long high, but it's certainly moved up a whopping 74% from the lows in March. URA has had 12 straight weeks of up weeks since March. So I want to get your take on what you think should be on the radar screen for those of us invested in uranium, those of us who may not be invested in uranium as well. We'll answer the question whether it's still too early or not, but go ahead and walk us through what are some of the key takeaways from this uranium market since we've last spoken about a month ago.
Well, since we spoke a month ago, Sprott had a $200 million bought deal raise. So they had done, back in March, they had done a $25.5 million private placement with a couple of institutional entities that had sort of filled their coffers, enabled them to avoid selling pounds of uranium into the market to raise cash. So they've got management fees, they've got various other smaller fees to keep the lights on. And these fees are generally paid with their balance sheet that is drawn down over time. And if they're not able to come in and raise through their ATM when they're trading at a premium to the previous closing day's net asset value, then they are sort of just dwindling down their cash. And in March, this was a precedent that was established with doing an off-market raise, and they actually did it. The participants in the raise paid a premium to the market. And this is like a 3 or 4% premium on the day that it was done. And that, again, just made it so that they did not have to sell pounds to raise cash. And that was despite the fact they only had to sell 50 or 100,000 pounds to raise a little bit of cash, and it wouldn't have really done anything to the spot price. There was a narrative out there that was one major reason why certain institutional folks were shorting the sector, because Sprott has to sell. So that went away. That concern went away, at least for the near term. But it also established a precedent that, okay, this is another mechanism for Sprott to raise. And this has always been, I suppose, theoretical that they could do this, but it never really made sense. Why would you put money into this and pay a slight premium to the market? You can accumulate units in the open market at a small discount. Why not do that? Well, you do it and pay a slight premium because you know the cash is going to go directly into the balance sheet. Whereas if you're buying at a 2% discount to NAV, arguably you're getting a better fill, but they're not getting any of that cash because they're not issuing shares through the ATM. So this is June 20th, so 12 days ago, when they raised $100 million, and then it was upsized to $200 million. And that immediately sent the stocks meaningfully higher that day. That was Monday, 10 days ago Monday. And you also saw traders in the spot market front running SPUT. So basically buying pounds in the spot market, expecting to sell those pounds right back to SPUT at a few dollars higher. And that's exactly what has been happening. So you saw a few 100,000 pounds, maybe 500,000 pounds traded, moving the price up about $5 that first day that the bought deal was announced. Now there's a little bit of liquidity there, and they've been filling into SPUT's purchasing. Now, SPUT at this point, as of today that we're speaking, they have enough cash left still to buy 700,000 or 800,000 pounds at about $80 a pound. So they still have some cash to work with. The spot market is cooling off a little bit here. It dropped, I think, 50 cents yesterday. It's right here about $78 mid-market. But that was a big event that I think, in my estimation, kind of moved us into new territory. This is apex financial predators, to quote the guys from Ocean Wall, kind of circling the sector and putting some serious money down in order to enable SPUT to actually do what they're doing. So this is new territory as far as we can tell. And how much more money is on the sidelines waiting to do something similar, nobody really knows. But what we understand is there is definitely more. There is actually a lockup, not really a lockup, but SPUT has agreed to not issue any more units into the market via ATM or otherwise for a 30-day period without the express consent of Canaccord Genuity, that was the bought deal participant. So that takes us to July 20th, unless they give permission for them to issue units. And they're trading at a discount right now, but they could do another raise off market. So might have a couple more weeks before that mechanism is, they're able to utilize that again. But we'll see. How often and how much, we don't know. But now this is there and this is hanging over. And since this happened, SPUT's been trading at a much, much smaller discount to NAV, much closer to NAV. And I think that going forward, having this ability to raise off market is likely to keep the trust trading closer to NAV. You know, most closed-end trusts will eventually, ultimately trade almost exclusively at a discount because they never are selling those pounds into the market to change that. So very interesting times. We've seen a good run in the spot market. It's gone from the low 60s all the way to almost 80, and that was over the course of about 2.5 months. The stocks have gone up 50 to 100%, depending on the stocks. URA has gone up, like you mentioned, 12 weeks in a row. And it's down a little bit this week, but 12 weeks in a row of an up move is historic for that ETF. That has never happened in its history. Much of that has had to do with Cameco. Cameco is 23-24% of URA, and Cameco has been driving URA higher, along with some other picks and shovels names that have been trading like meme stocks. So URA has sort of been pulled up by a few of their larger holdings, primarily Cameco. Uranium, being a pure play uranium mining ETF, hasn't moved as much. And to be fair, the spot price is up, $3 or $4 on the year. It's not a huge run year to date. It's a big run from the lows of early April. But as of right now, these are mining stocks and they're going to trade relative to the metal. So until we see a big, robust move, I think through 80, 85, and eventually back up to new highs, and that's going to have to, by nature, involve the utilities. And the utilities right now are still largely out of the market. There was some decent activity going back mid-February through, let's say, mid-April. A lot of carry trades getting done, a lot more volume in the spot market. Still, year to date, 26 million pounds in the long-term contracted market. That's about to change. So will we have a slower July? Maybe. That looks likely based on what we're seeing in the physical market right now. So maybe a little bit of backing and filling, not only for the price of uranium, but possibly for the equities. That's entirely possible, would be perfectly healthy, technically speaking. But we know that there are multiple mid to large size RFPs that are going to hit the market in the coming weeks and months, going into a strong season for uranium. And the long-term price, we're going to start to see that move. If not in July, it's going to push into mid Q3, Q4. We're gonna see a good run here coming up to end the year.
Yeah, I have the uranium chart here, and you can see it illustrated just like you said. We kicked off this initial leg up in the uranium price somewhere around, we had a bottom somewhere around here in 2016. And of course, this is on a log scale. If you go and look at it from a nominal scale, then you can clearly see the rapidity of the move up that we witnessed in the early 2020s, right? 2020, or late 2020, 2021, and 2022. And we've been experiencing this drawdown in the price from 110 or so dollars all the way up here in 2024. We hit our low here in March of 2025 at around 64, 63 some odd dollars. And now we're at 77. And if you look at the various ETFs, we also have URNM here. Let's go ahead and look at it from a candlestick perspective. And you had that March or late March, early April bottom during the initial tariff sell-off, Liberation Day sell-off. back then, but since then it's been grip it and rip it. URA is even more to the upside, like we alluded to at the beginning of the podcast. So you've got a decade long high that we've hit on URA. Of course, URA is it's 70% in uranium. It's not a pure uranium play, is it? Right.
And that 70% includes Cameco, which is not exactly just a pure miner either itself.
Right.
Yes.
So you've got Cameco here as well. Cameco is making all-time highs. So what is Cameco telling us here, Justin? Is Cameco the leading indicator for the uranium market?
Cameco, in my opinion, has become more than just a uranium mining stock. It's sort of it's the belle of the ball when it comes to the nuclear renaissance plays, because you are not only getting exposure to uranium mining, which they are, besides Kazatomprom, the largest publicly traded miner, besides Kazatomprom. You have uranium mining, you have conversion, both through Port Hope and potentially through Springfields in the UK, which was owned by Westinghouse. You have exposure to enrichment with their 49% ownership of, or I think it's less than that currently, but minority ownership of Global Laser Enrichment, which they expect to be in commercial production by 2030. And Cameco will have and does have the option to increase their ownership of that. They have fuel fabrication through Westinghouse, and they also have actual reactor builds through Westinghouse. So it's really a one-stop shop for exposure to the quote-unquote nuclear renaissance. So I think that's why, one main reason why it's been trading the way that it has. It's a sector leader. The uranium mining stocks are still, as far as we can tell, pricing in the current price of uranium, and they have moved relative to the spot price pretty significantly over the last 2.5 months.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
But still, not a lot of outperformance of the spot price like we saw really in the big first leg of this uranium market. And if you go back December 2020 through November 21, that was an absolutely massive move for the miners relative to the metal. We think we're on the cusp of another move like that. So that, which is to say, we could call that the second big leg of the market. That's what we believe is coming. 5 years later, this is really a stretched out bull market. This is going to be a generational trade. This is going to continue for many, many years into the future. There, of course, are opportunities to trade in and out of this sector. Now, I don't know that we necessarily go absolutely straight up from here. I think we're going to back and fill a little bit for a month or maybe two. But once we start to move again, and once there's an understanding that more of these mining companies are going to be actually producing some cash flow, and they'll be selling uranium north of $100 and potentially far higher than that, we're going to see significant re-ratings in the mining stocks. So the mining stocks ultimately trade based on the movement of the metal itself. Now, you buy mining stocks for leverage, and of course that's theoretical, and it's something that a lot of people have been speculating on in the metal space and the gold and silver space. And sometimes you get alpha by positioning in the mining stocks during a metals bull market, and sometimes you don't. And as of now, we have yet to see a really, really strong alpha move of the miners relative to the metal. Part of that, I think, has to do with just the market still being very, very skeptical. We've seen a lot of rug pulls in this sector. And I can tell you right now, absolutely everybody is ready for this slow summer, is ready for the stocks to crash back down, because they've been rug pulled 6 or 7 times in the last 3 years. So that is to say that the rallies don't have legs. They move up for a month or 6 weeks and then they get sold off into. And it feels a little bit different now, not only with the spot raise, but it does feel like there's a tiny amount of optimism kind of seeping into the investor psyche here. we had an enormous amount of capitulation. A lot of people threw in the towel between December and April. Very, very, very bad sentiment. And that's going to take time to heal and move back up. And right now, everybody is hoping this stuff comes back down because there's a growing understanding of where this is ultimately going. And where it's ultimately going is much, much higher in terms of the price of uranium, and ideally also for the mining stocks.
Yeah, it's very fascinating you say that. From the perspective of new and old investors, is now still an early time to deploy capital into uranium stocks? Or given the fact that you've seen some of these mining companies perform at the level that they have, that we've alluded to the last couple of months, is that not the time otherwise? In either case, why do you think that may or may not be the case?
I would say it depends on your outlook. If you're looking as a short-term trader, a 10 to 12 week V-shaped recovery is not exactly the point where you want to pile in. I have a hard time buying when stocks are overbought, and they are decently overbought here, not severely. We're starting to see RSI get a decent little reset, but right now it feels like we're right at this strange crossroads where if things get quiet for a few weeks, we'll probably consolidate, but a single headline could drive the sector higher even still from here. And that's just kind of where it feels right now for me. So are we early if you're a short-term trader? No, you just missed a 12-week run. Are we early if we're talking about the United States getting 10 large reactors under construction in the next few years? 3 Mile Island now going to be restarted a year earlier than expected. The utilities have yet to contract a single year at replacement rates, and we know that that is coming. That's not coming until we see higher prices because there's not enough uranium on offer at this price. So we are very early if you're considering a long-term vision for where the sector is going, the growth rate of nuclear, the de-risking of the demand, and the fact that utilities have a very, very large amount of uncovered needs going out for the next 5 to 10 years. What happens when utilities step into the market? It's going to drive prices higher, period, the end. So we're early from that perspective, but if you're looking at, piling into full positions, full starter positions right here, I would be a little bit cautious. Generally speaking, we have always recommended to tranche into positions over multiple weeks, if not multiple months. If the broad market, which is at an all-time high right now, decides to come off 5 to 10%, while the uranium market is quiet, we'll come off 10 to 20%. And that would be totally technically normal and healthy and with enormous precedent. So very volatile sector. I would say, are we early or late? Depends on your outlook. If you have a mid to long-term vision for a very, very long-term bull market for a strategic commodity, I would say we're still early, Danny. And that largely has to do simply with looking at what have the utilities done so far in terms of their long-term contracting strategy. Not much. They've basically done everything they can in the last 4 years to avoid stepping into the long-term market in size. Flexed up on old contracts, bought some EUP from various sources here and there, bought a lot of conversion and enrichment. There's still a lot of uranium that needs to be purchased on the behalf of utilities. Almost half a billion pounds going out to 2030. So we have a lot of uranium that needs to be purchased on behalf of utilities, and that's what we have in front of us. So from that perspective, we're early. If you look just at the charts, a little bit overbought after a torrid run off the lows in April.
Yeah, you often hear this term that uranium is the rock star commodity. It's the rock star of all the commodities. And, we cover this a lot. We cover the commodities market here a lot on this channel. A lot of calls have been made about stagflation, more inflation coming down the pike, increasing prices on the things that you need and so forth. But why is uranium, what uniquely qualifies uranium versus any other commodity market? Granted, all these commodity markets are unique in their own way, but why should investors pay more attention to uranium stocks versus, like, say, silver stocks or gold stocks or copper stocks or any other natural resource stock out there? What makes uranium the quote unquote rock star commodity?
Sure. Well, just for some context, I as somebody who knows more about this market than most, and I know more about this market than any other commodities market, I don't only own uranium. So right now, I'm generally a long-term commodities bull, to speak very, very generally. I have offshore exposure. I've got gold and silver exposure. I have some copper exposure, some nat gas exposure. Uranium is my largest position by a pretty good long shot, but diversify, important. I don't look at this ignoring everything else in general capital preservation practices. Disclaimer, wink, wink. With that said, there's some really, really unique elements to this commodity. One of them is that compared to many other commodities, demand is relatively easy to model. So rather than trying to guess whether or not OPEC is going to cut or they're going to raise production, that is something that can throw a wrench into the oil market. Demand is something that can be modeled based on looking at the reactors of the world that are currently operating. How long will they be operating? And that's something, the data is all out there. What reactors are under construction? When will they be hitting the grid? And what does that demand look like? And then you have to put some assumptions in there based on life extensions or not, expected shutdowns. That information is decently abundantly available. Like, we can make a pretty accurate assumption, I think, that every single reactor operating in the United States is going to go out to 80 years at this point because the demand is so great. We still are not modeling for Diablo Canyon to be extended, even though it's probably going to be extended in California. That's the one that we don't make an assumption on an extension. But the demand is pretty easy to model. And there aren't really any expected surprises to that. That is not to say that we also couldn't have some sort of nuclear accident that's always potentially looming over this sector. And that's something that makes it exciting and volatile and unlikely to happen, statistically speaking. It's only happened a few times in civilian nuclear's history. The last disaster, which was the Fukushima Daiichi accident, I say disaster, nobody was killed by this accident, but it certainly hurt sentiment in the short term and then hurt demand in the mid to long term, which affected the sector for a decade. So it mattered, and that potential is always kind of there, but you can model demand easily. Supply is a little bit more difficult, but still.
And Justin, I mean, even with regards to those disasters, as catastrophic as they may have been, it exemplified to the world that in the long run, they're really nothing burgers in that sense. So I would suspect, like, this is my suspicion, that any future disaster of that magnitude, we do have precedent for it. So the panic, I would presume, would be a lot more subdued. And given the fact that we do have, we are hitting this energy crisis where we do need to, look underneath the sofa for every nook and cranny. Every form of energy is on the table right now, and nuclear is a massive. It's massive baseload energy, unlike fossil hydrocarbons are in this regard. So yes, I mean the risk is there for a big disaster, but I mean, don't you think that given multiple occurrences of disasters in the past, that any future one would be somewhat subdued in public sentiment?
I would generally agree with that. I'm always careful to not just brush this over, because
Right.
I think any type of nuclear accident, regardless of how severe or not it is highly likely to affect sentiment negatively in the short term,
Right.
at the very least. But I generally agree. The world's fleet is safer now than it's ever been. And Fukushima was a gut check for all reactor operators, and safety protocols were shored up following that accident. So it's safer than it's ever been. The operating reactors, to your point, are very, very important strategic assets. So if we had another accident, even similar to Fukushima size or scale, would we have knee-jerk reactions like we saw for the Japanese fleet, for the German fleet, for Spain, all implementing phase-out policies because of that accident? Maybe, maybe not. But I would argue the big demand drivers, which are the United States extending their fleet, China building a fleet, 10 reactors a year at this point is the pace that they're on right now. Is that going to stop because there's an accident somewhere else? Probably not. So I do think that there's some stability to the demand, even with the worst case scenario kind of black swan. But that is always there, and that is a left tail potential. It's always there. Coming back to the ability to model this sector, and don't get me wrong, it's an exhaustive exercise. We have done it. It's thousands of hours to have an extremely complex spreadsheet of every single reactor operating in the world, when it's going to shut down, will it be life extended, everything under construction, all of that. We have that all modeled out. Then you get to the mines, and you've got 100 mines in the world that are either operating, moving towards production, or maybe will be developed in the next 10 to 20 years. And that sounds like a lot, but it's really not. So you can actually get a solid understanding of the supply and the demand in this sector without a whole lot of surprise variables. And those surprise variables can be huge in other markets. Copper is very driven by how much China's industrial demand is growing or not. Oil can be sent up or down by hot war or not. Certain shipping lanes being closed or opened. OPEC's, all of these things can affect these markets substantially. We don't really have that here. We have a stable amount of demand that is growing at we model right now for about 3.5% compound annual growth rate for the next 10 years. That's pretty significant. That's more than double what it was 5 years ago. And that is stable. We are able to see that. And it's something that can give us an enormous amount of confidence in the overall long-term trajectory for the commodity, so that we know what to do, generally speaking, when the market gives you these vicissitudes. They go up and they go down, and there's volatility, and you can trade around that. So when you have March, April of this year, when the stocks are dumping and the broad market is pushing the stocks down, and the spot price is dribbling down, if you know what's happening in the physical market, and you know what will happen in the mid to long term, ultimately, that can give you an enormous amount of conviction to put money to work when everybody else is throwing in the towel, and it's worked out extremely well for us. So having an understanding of the supply and demand is crucial, and this market is unique in that manner. I would argue one more element that makes uranium very unique is that it's the only fuel for the world's reactor fleet, and they have to buy it. You can't have a 10, 15, 20 billion dollar asset go idle because the price went up $5 or $10 a pound. That just doesn't happen. It's never happened. Could it happen at $250, $300, $400 uranium? Sure, that is entirely possible. Maybe we'll get there. I don't really know. I tend to think we're going to have a more, let's say, a more natural market where we see the price consistently rise, and eventually we will see supply respond sufficiently. Will it overshoot to the upside? It probably will. I think $150 a pound is coming, whether that's in this next leg or the leg after that. I can't tell you, but I think that's where we're headed. And understanding that utilities have to buy this fuel, whether it's $75 a pound or $150 a pound, they don't have an option. You can't power a reactor with anything else. So it's a must buy for utilities. The price, they're not price insensitive. Anyone who says that is potentially trying to sell you something. They have to buy it, but the price does matter. And so how they act in the physical market is often driven by the present price. And when the price is going up, they tend to step back into the market. With all of that said, it's only 5, 6, 7% of the overall operating budget of a reactor is uranium. Now, the whole fuel cycle is much more like 15 to 20% of their operating budget. So that's uranium conversion, enrichment, fuel fabrication. All of that together is a larger chunk of the overall operating budget. Uranium is about half of that. So 7, maybe 8% of the operating budget is the uranium cost. And the utilities right now, especially in the Western world, are making a lot of money selling electricity. The price is going up because of the demand that's being brought to the market by AI data centers. So it's a good market for them to operate in, and they're going to be willing to pay that price. They really can't just shut down a reactor because the price went up. So it gives you a lot of de-risking on the demand side, knowing that they have to buy it regardless of price.
Right. And I mean, the level of detail that you just laid out here, Justin, I mean, this just exemplifies why, I believe that if you are going to invest in uranium in this space, you could always just buy the ETFs, whether that be SPUT, whether that be URNM, URA. But if you want to take it to the next level, I really do encourage my audience to, check out the Uranium Insider newsletter. You do a fantastic job on going into the nitty gritty of this sector. And I'm also happy to announce that we do have a special deal for viewers of this channel. Right now, you can get $50 off the quarterly plan and $300 off the annual plan. And Justin, who is this newsletter for? Who is this newsletter not for? Who should who should be seriously considering investing in the newsletter?
I think anybody that has a decent amount of money at work in this sector needs to inform themselves of what's going on in the physical market first and foremost, period, the end. I have, like I mentioned, I have money to work in other sectors as well. And I'm a subscriber to 3 or 4 different newsletters at this point. And so I don't have the time to research every single sector that I know I want to have exposure to. So I outsource that. I buy information via newsletters. That's just how I operate. I know that a lot of our members also are members of other newsletters as well. So it seems like that's a popular path is to invest in quality information when you have money at risk. And so anybody who's exposed to this sector, who has a mid and long-term outlook and wants to keep tabs, especially on the physical market, you want to know who's in the spot market, what is being traded, at what price, what are utilities doing, what RFPs are out there right now. We also offer in the checkout process for the newsletter, you'll have the opportunity to add a service in addition to the general newsletter, which is the weekly uranium market report. And that's something we put out every week. And that goes into detail what's happening in the physical market. So we discuss the volumes traded in spot and term, and we discuss the nitty gritty details of who's buying, who's selling, and where we expect it to go in the coming week. So despite the fact that we have a very long-term positive outlook for this commodity and for this trade, we communicate on essentially a daily basis on what's happening in this market. So if the money you have at work is important to you, which it probably is, and you have exposure to this extremely risky and volatile sector, I would argue that the cost of our newsletter, at a cup of coffee per day or even less than that is something that is invaluable to protect the capital that you have at risk in this sector.
Fantastic. And we do have a special link to that discount down below in the description box, as well as the pinned comment. Look out for that special link, guys, if you're interested in Uranium Insider. Justin, thank you so much for taking the time to come on the show. It's always a pleasure having you on. I think I told you this last time, but you were in fact the first guest that I ever had on this podcast back, now looking back, it's 3 years ago. So we've had a pretty good run. So very happy to have you on again. Thank you so much for your time. Anything else you want to tell the audience, talk about before we wrap up here?
Only thing I would say is if the market goes quiet here for the next month or 6 weeks, which is possible, if that's the case, any sort of dip that we are given this summer, I would strongly suggest to utilize that opportunity to shore up positioning, because we are expecting a much, much stronger move in the price and move on behalf of utilities to finish out this year and heading into next year. So definitely take advantage of any opportunities the market gives you. This is a buyable dip if we get it coming into the next month or maybe 2. And leading up to that, we've got the WNA conference early September, fuel conference later in the autumn, new budgets for a lot of utilities October 1, and just a typically strong season. And on top of that, it's not just a seasonal trade. It's taking a look at what the utilities have and haven't done leading up to this moment in time. So a lot of the movement in the spot price coming off the lows of April to now has been driven by the financial players, primarily SPUT, over the last few weeks. So utilities, while they've been more active than usual in the spot and the carry trade market late Q1, early Q2, still have not come in barely at all in the long-term market. And that's what's going to be driving the next moves higher. So knowing when that is coming and what is happening when it does is very, very important as a uranium investor. So keep an eye out on the next few months for that opportunity.
All right. Very good, Justin. Thank you so much for coming on, my friend. Guys, if you enjoyed this podcast, drop us a like and comment, go, Justin, go, in the comment section. If you disagreed with anything, that's fine too, but let me know what you disagreed on. I do, in fact, read the comments. Also, subscribe to the channel so you don't miss another episode. Liking, commenting, subscribing, all of it goes a long way in helping boost the visibility of the channel in the algorithm. So a little bit does go, in fact, a long way. Also, check us out on Substack. It's capitalcosm.substack.com for early access, ad-free versions, and uncensored versions of all of my content. And with all that said, thank you guys for your time, and I will catch you later. Bye.